Hello, everyone. Welcome to another day, another episode on LATOKEN VCTV, where we come again and discuss trends and issues around the globe with our invited panelists from all around the world. My name is Oluwatomi Nathaniel Amida, and I am hosting the show out of Lagos, Nigeria. And today I have one guest. And Randall, please introduce yourself to the audience, give a bit of a background, and let them know who you are.
Yes. Hello, everyone. My name is Randall Laveau. I am calling in from Atlanta, Georgia right now. We are about to prepare for Memorial Day here in the United States, so it's an exciting weekend coming up. My background is in growth. I've been a serial entrepreneur and investor for the last 20 years. I've spent time in the corporate world as well. I was a CMO for Magento Commerce, helped divest them from eBay Enterprise, and later sold them for $1.8 billion to Adobe. I started a consulting practice focused on turnaround and change in the portfolios of private equity companies. So a lot of time working with early stage startups, helping them scale and grow, and ultimately, meet their final objective, which is either IPO, exit, or a lifestyle business. So now I spend my time working as a co-founder and CRO of Boss Capital Partners, an investment syndicate. And I also co-founded a company called Boss Startup Science, which helps entrepreneurs efficiently move across their maturity life cycle to achieve their optimal objective, which hopefully is a strategic acquisition.
Awesome. Thank you for that intro. Hopefully, as the show goes on, we might get more guests, but we'll start off with you. And if you're joining us, we are live on YouTube, Facebook, Twitter, and on LinkedIn. You can be part of the show by simply dropping a comment in the comment section. If I get to see, I get to give you feedback in real time. So please go ahead and share our content. Yes, share and subscribe to our content on whatever social media you're watching on. So today we'll be discussing the business for exit and strategy. And when an entrepreneur starts a business, the idea is to grow big, make money, and all that. So today we'll try to understand why business exit strategy comes into play. And Rhonda will be helping us understand more of that. So just let us assume that we do not know what this means at all. And for the newbie audience, what is a business exit strategy and why is it even important? What are the possible reasons for a business exit strategy?
I mean, I'll start out with an analogy first. When you want to go somewhere locally, let's say you want to go to a new store. You don't know where the store is, but you know you want to go there. So you get in your car and let's say you just start driving and hope that you run into your destination, right? That would not be the appropriate way to go to a new store. What you would do first is you would get your GPS, you would punch in your coordinates, where are you today? And then where do you ultimately want to go to? And what the GPS will do is it will find the best route and most efficient route for you to take. Now, if you think of that like a business, personally, and from our point of view at Boss, it would be ignorant of an entrepreneur to start a business without knowing their end destination, or at least having an idea to it. And we say this a lot at Boss, where all growth is not good growth, right? There is a proper way to grow to maximize valuation, make sure delusion doesn't creep up on you, and that will ultimately help you to not run out of cash at the important milestones of your journey. So when we looked at the number one reason that companies fail, it was running out of cash or inability to raise investor funding. And a lot of this is because investors do not have confidence in the idea because you are not taking a methodical approach to building the business, and they don't know where this business is ultimately going. And if they don't know where the business is ultimately going, then they don't know when they're going to get their return. And remember, investors expect a 2 to 5x return on every investment they make. So part of that would be knowing the end destination. When am I going to get that return back? Having an exit strategy, whether you actually fulfill that exit strategy or not, is like having a North Star, so you at least know you're headed in the right direction.
Awesome, awesome. And like you said, one of the number one problem most entrepreneurs face is running out of cash. That was very little or zero management. And I just want to stop there and welcome our guest, Dr. Shrikant. Dr. Shrikant is calling out of India, if I guess right. Please, Doctor, introduce yourself to the audience just before we go ahead.
I'm so sorry. You would hear me panting and fronting. I literally had to run to get to this meeting. I'm really sorry. To my apologies to the panelists and apologies to the audience for the delay. I joined from India, and I act as a legal counsel for Who's Who. And this is, what Randall said is exactly what has been echoing in the boardrooms of various Fortune 500, I would say, founders as such, founders slash families as such. So I'm more than happy to give a perspective if my time is now. Otherwise, I should stand adjourned at this particular moment.
Yeah, please go ahead. Go ahead. I was just about to add to his question, but go ahead.
Sure. So my perspective, or rather my take, as far as let me give you a regional perspective, and then let me take you as an international perspective. We, as a India, as a subcontinent, the Indian culture has always been about foreseeability and reliability. And foreseeability is when you have certain visibility over the risk that you take, which is in terms of the investment that you make. And as Randall very rightly pointed out, the 2x to 5x, even even exorbitant excess that the founders or these family offices put on the heads of potential entrepreneurs, it has always been with somebody like me whispering in their ears that, look, at this particular stage, at 2.6 years, this is what my model shows you, and this is where you're going to get your return back. It's a no loss, no profit kind of, or your break even. It's a no loss investment. That's number one, which has been embedded in the culture. So that's a cultural embedding that I'm talking about. What is happening pan-Asia or globally right now is, now we are already averting the risk of COVID. Now, on top of it, we are also trying to, or the people who are trying to invest are also trying to avert the risk of not getting back what they have invested. So they are taking multiple measures. So people are not, you don't walk into earlier, I have encountered phenomenons in the past where entrepreneurs walked into a particular venture capital or a family office, flashed their fancy PPTs and asked them to write a check. And this happened literally in front of me, and I was whispering in the ears of the GP that please don't invest. There is heavy risk. Don't without doing your DD or without doing your due diligence, please don't invest. And they just cut out a check. Those glory days are gone. It's an invert right now. So people should be a lot more, I would say, pragmatic in their approach in terms of forecasting. That's number 101 that I would like to give advice to entrepreneurs, that when you're forecasting when you're putting on these mathematical models, don't be very, very optimistic about, you can be optimistic, but there is a very gentle difference between being optimistic and being realistic. So I think that balance has to be struck. That's where I rest my case.
Yeah.
Oh, wonderful, wonderful. Randall, you are going to say something. You're going to agree?
No, Doctor, you look like $1 million, man. That tie and suit on right there. I feel embarrassed. I'm so under. I always wear a hoodie. You look sharp, man. That is cool.
He always does look sharp. Trust me.
Yeah.
So don't feel bad. He does look sharp all the time. So Randall, you gave a detailed explanation of how a company should have a goal in sight, and that goal should always lead to the exit strategy. Is that the only reason, or one of just the possible reasons for an exit strategy? Because I read and I studied that some might be influenced by market conditions or boredom. I mean, those are other possible reasons for an exit strategy. How often do you see, or what is the common exit reason for an exit strategy that you come across?
Well, let's look at it from this way. If you do not have an exit strategy set up, you do not know how to grow the business appropriately according to the market's wants and desires. So the way that we use exit strategies is the first thing we do in what we call a North Star. Pretend this is your strategic vision for the organization. We first identify the ideal customer profile, and this is very important. We want to know who we're selling to. And then we want to look at the ideal acquirer profile. These are who are the potential buyers of our business. And there's a couple things that are happening in the market that you could identify from your potential buyers. And you want to know where they're going with their market position. Are they in an exposure market? Meaning they're planning to expose themselves to a new audience, and you could tell by the acquisitions they're making that they're making a move for that. Are they an expansion market? Are they expanding within their current base, which means you having the same type of customer is important because they're going to want to buy you because you're going to increase the share of wallet out of their already existing customer base? Or is it a share market, something very difficult where they're just passing customers back and forth? That's going to dictate what your acquirer is going to be looking for. Now you want to go a level deeper and you want to understand over the past couple of years, these acquirers that you've identified, what type of acquisitions are they making and what are they making the acquisitions on? Is it top line or bottom line? What is the revenue at time of acquisition? Are they concerned about margin? Is it retention? Or is it customer attachment rate? Meaning I have the same customers, I'm serving the same customers as my potential acquirer. So once you know these, you now have valuation drivers that you could pull on to either make yourself more attractive to the buyer or potential acquirer, or just improve within the marketplace because you know that they've laid the tracks for you and you have the ability now to ride on their coattails and pick up those excess customers. So I don't look at it as an either or. Whether you want to exit your business or not, it's an appropriate way to build the business, making sure in the early stages, the first year 1 through 5, you're growing according to what the market is asking you to do. And then if you want to make an adjustment, you don't feel like you want to exit at year 5, go ahead and keep it on the tracks for another 2 to 3 years or whatever it may be.
Awesome. Thank you. Thank you very much. I mean, a lot to process there. Dr. Shrikant, what will make an acquirer or an investor find a project attractive? I mean, what is it in their business strategy, exit strategy?
So first off, let me respond to the comment made by Rendal. While I may look like $1 million man, people are the people who pay me the $1 million are the people who wear hoods like you. So so I am not the millionaire over here. So we could agree that who's a bigger millionaire amongst us. So that being said. So coming back to the topic, the topic is what are my experiences, so to speak, when a founder slash the family slash the GPs is looking at when they are looking at a pitch. So from an exit point of view, there is generally a broad consensus is what I've seen amongst the partners. So now we have to kind of segment, right? The family offices have a different kind of exit. The VCs will have a different kind of exit. The VCs will have a standard exit, which is determined by their LPs and GPs together, coming together, and their investment plan. So there's not much that you can do in terms of the exit over there. That's number one, which is something that I found. With regards to the family offices, it's more tailor made, and you can kind of speak to them and say that, look, instead of a 4 year public issue, I would rather do a 7 year public issue. Instead of a 4 year private equity placement, I would rather do a 7 year private equity placement. So it becomes, and then you can draw down on more funds and so on and so forth. So that brings back to the same question. So what am I looking at when it comes to exit? So the exit mapping that we do at the beginning, which is when we invest, when we cut a check, or when we write a term sheet, and the exit which happens at a 3 year horizon or 4 year horizon, we kind of map it to what was said and what was done. So it is not that the exit happens out of the blue, and you sleep in a pod, space pod, and you wake up and see the world has become 2020. 2025 is not a good example. It used to be a good example in 2010, but the world has become 2035. So it's not that. So the companies are being monitored. There are MISs that kind of flash out, or information which is fed by the company in terms of, say, your monthly sales, your monthly revenue, monthly profit, I mean, EBITDA, your monthly certain parameters, certain metrics. They kind of indicate as to at what position you are in. So we kind of, the founders will get a sense of it, but I'm not underestimating the founders. Before even the founders can even get a sense of it, we as GPs or legal counsels, we not legal counsels. I mean, I'm a blend of finance and legal professional. So the finance side of me kind of senses it out quite early. So it's not a slap coming out of nowhere, right? We know exactly where it is coming from. So the exit. So I'm digressing from the question. So the exit strategy is kind of mapped, and the moment we know that this particular move by the company, by hiring one more CXO who's paid say $1.5 million plus ESOPs and so on and so forth, is going to deviate from the overall plan. We kind of know it beforehand, right? So we kind of make those adjustments beforehand, and if it doesn't comply to that, then the conversations go here and there, right? There's always a possibility, but a exit plan is a good exit plan will be an exit plan with where the founder himself or herself has kind of mapped that look, gives a very clear vision that look, this is what my exit is going to look like, and it is no surprise. We don't like surprises. The first and foremost thing. I mean, any surprises that come our way, we are okay for legitimate and expected surprises, which is a paradox. But we don't expect unexpected surprises, which is again a paradox. I'm sorry.
Yeah. I think I get that. I get that much. I mean, and this thing about exits, I used to believe that exit was mapped to a timeline. So, for example, 5 years, 10 years. But now it seems that there are other factors involved in timing this exit strategy, and it's important that every founder or entrepreneur needs to understand this from the beginning. Which goes to my next question, or something I think it has been answered by the way. And it's like the best time to plan or prepare for an exit strategy. I think Randall said something that the best time is at the beginning. I don't know if Dr. Shrikant has any other view or opinion of this.
It's a best time. See, now earlier the funding opportunities were limited to new ideas. Now funding opportunities are even exploring to old ideas which are available at cheaper valuations. So for an investor, it's a merry time, right? I mean, you've got a yard sale plus you've got a merry sale as well. It's like Black Friday combined with a yard sale and so on and so forth. So I see that as a merry time for us at least. What I don't see as a merry time is people who got big checks in say 5 years ago or 6 years ago and are struggling to to kind of pivot, who have not pivoted till now. I mean, it's been a year since the COVID has hit us, and who have not pivoted till now and are again going and knocking at the doors of the VCs or family houses. I see a bad time for them because no more checks are coming through, unfortunately.
Unfortunately, thank you very much, guys. It's been a powerful session, like informative session, and I guess there's a lot to learn. If you are out there watching us live, you could easily go back and learn more from the beginning of this session when Randall started. Learn more, and obviously there will be an opportunity to connect with these guys, Randall and Dr. Shrikant, I guess on LinkedIn. Yeah, and but before we go, as we round up, before we go round up, what is your with your experience and your knowledge, any advice to a founder out there, to an entrepreneur out there about the exit strategy?
Okay, so I'll end with a story, a horror story that I experienced personally when it came to an exit. So my first business I had for over 10 years, and I built this business just based on growth. I was serving a very diverse customer base. Half of my customer base was in marketing. The other half was in 4 different industries. At year 10, I thought it was a good time to sell. I had no strategy before this. I just knew that business was going well. We were making good money and someone would want to buy us. Sit down at the table for the acquisition. Come to find out that they only cared about 50% of my customer base. And I was only going to get paid and recognized on 50% of my customer base. So the exit that I thought that I was walking into was half of what it should have been. I had to go back. I decided not to move forward with the transaction. I went back, let go of half of my customer base, built it up again. And luckily the market didn't change a lot. So I was able to go back to the table in 2 years and get the deal that I thought I should have got. But it's very important to think about this from the beginning. You need to know, if you're going for a strategic exit, what they value, because you could be building the business from the beginning in the wrong way.
Awesome. Dr. Shrikant, do you have any horror story or
No, I believe Randall's story is something that I have encountered as well. So from a horror story perspective, I'm a legal counsel, right? So we live in horror stories. So we live in unratified deals and term sheets which are signed and not honored, and so on and so forth. So I wouldn't be in a position to comment on a specific horror story, but yes, there were times when exit seemed like a exit seemed like good strategy, but the founder walked out or the family just walked out just because they didn't like. I mean, I have had instances because they didn't like the color of the tie that the founder was wearing. I mean, they're having these stray incidents. I mean, these are not sane I mean, these are not sane investors. I mean, I've moved away from them. Keeping that aside, keeping these stray incidents aside, my horror stories have been specifically, repeating horror story has been where the exit that you think is not the exit that you get. So you kind of revisit, and when you sleep on that and come back, you kind of come back to your sanity, right? You think of being a billionaire when you go or walk into a boardroom, thinking that this particular billionaire is going to buy you out for $1 billion, but you come back with certain reality checks. That has been a frequent horror story, which is no legal repercussions. There are horror stories which have got legal repercussions as well, where force majeure, and I could go into circumstances have changed. So COVID is certainly an event that entrepreneurs should keep in mind. Don't overplay COVID. At the beginning of COVID, I saw a lot of entrepreneurs, using COVID as a term to say that, look, we're different. Now the usage has gone a little stale, in my opinion.
Yeah.
So don't overplay it. That would be my thought. And Randall, keep on coming. I mean, we are looking for billionaires like you so that I can become a millionaire. Please, I mean, don't stop doing what you're doing. So that would be my piece of advice.
Oh, when I hit $1 billion, I'll be on a beach somewhere. My name will just. It's so good to meet you, Doctor. Yeah.
Yeah.
Pleasure
And
being
I'm sure everyone can get connected on LinkedIn, especially if you're a startup or have a business and you want to make a pitch. You can easily reach out to the LATOKEN team or reach out to Randall or Dr. Shrikant to get the kind of advice that you need, especially on a topic like this, an exit strategy. You need more information. Reach out to our panelists and then set something up, and maybe they will have time for a call or two. So guys, thank you very much for being part of today's show. It's been awesome, especially Randall, meeting you for the first time. Dr. Shrikant, you look like $1 million too. So until next time, guys, have a great day, have a great weekend, and see you next time.